Welcome back to Businessline and on a special segment on mutual funds. I'm joined by Aarti Krishnan, who heads the Research Bureau at Businessline. Last week, we discussed the various jargons used in the mutual fund industry and simplified it for you. Now we get into the crux of the matter and how do we select a fund, which is the right fund for you. Suppose I'm building a new fund, Aarti. So which is the kind of fund that I should be looking at?
Before you begin running down the list of funds, you should start with deciding how much of your portfolio you'd like to allocate to different kinds of funds. In the previous shows, we discussed the types of funds like equity, debt, balanced funds and so on. So the investor should first decide how much of his money he can afford to put into equity funds. Now to do that, there's a simple rule called the 100 minus age rule that the financial advisors usually follow. So that consists of taking your age and simply subtracting it from 100. Suppose you're 20 years old, 100 minus 20, 80 should be the proportion of the money that you put into equity funds. But in the Indian context, I would not advise investors to take on that much of risk because an 80% equity portfolio can swing quite a bit and it can really give you some sleepless nights. So what I'd suggest is do a 80 minus your age rule, that is take 80 years, if you're 20 years old, put 60% of your portfolio in equity funds, keep the rest for debt and other investment options.
So I'm 20 years old and if I need to invest 60% of my funds into equity, which are the funds that I can choose from?
You have a huge amount of choices to take your pick from. There's a mind-boggling variety of funds on offer, diversified funds, thematic funds, index funds and so on. You needn't get confused by all this. All you need to do is stick to diversified funds. I wouldn't advise thematic funds for a novice investor because typically thematic funds take exposures to particular sectors. There may be a telecom fund, an infrastructure fund and so on. To really get the best out of these funds, you need to know how these sectors will perform. That kind of a call is not easy for a normal investor to take. So the first rule is stick to diversified funds. The second thing is try to pick funds which can go anywhere and do anything. That is, do not go for specialized things like mid-cap funds or small-cap funds or things like that. The third thing is look for a 5-year track record on the fund that you're choosing. If the fund has not been around for 5 years, there's no proof of its performance. So once you look at the 5-year track record, see whether the fund has managed to outperform the benchmarks, say the Nifty or the Sensex over that 5-year period. Once you do that, it becomes easy to pick out the funds that could be a good fit for your portfolio.
So are we saying that the last, whatever the past performance of a fund is that the way to look at it for its future trends, to look at equity funds which have performed really well and then sort of look at what the future performance should be? Exactly. Is that the judgment call there?
Yes. You cannot take it as a guarantee that the past performance will be repeated over the next few years. Typically, you cannot say that if a fund is up 80% in 2009, 2010 will be the same. But what I'm referring to is looking at a longer term track record. If you look at a fund's returns over a 5-year period, for example, you will know that the fund manager has skillfully navigated an up market and a down market and a back again. And if he's done well over that entire market cycle, then that's a good fund to own. So to that extent, a past track record is a comfort factor when you choose a mutual fund.
What else can we look at in this case?
There are other things to look at because in the Indian context, there's a lot of churn happening within the fund industry itself. It's after all a very nascent industry. So there's a lot of attrition happening. So fund managers of your funds and the management teams of your funds can change. So once you look at a track record, you have to ensure that the track record will be repeated. To ensure that, you need to know the fund manager is continuing to manage the fund. The second thing is there's a lot of churn also happening in terms of consolidation, takeovers, mergers and acquisitions within the fund industry. So you need to check whether the fund's ownership continues to be the same. The third factor you look at is costs. Costs are emphasized a lot, especially in the developed markets where funds find it difficult to outperform their benchmarks by a large margin. So the 2% or a 1% fee that the fund charges, that is a very important factor that they take into account. In India, I would say costs are a less important factor because some of the funds outperform by really terrific margins like 10 or 15% ahead of the Nifty or the Sensex. So when that happens, the 2% cost doesn't matter too much. But if you're choosing index funds or debt funds, then the cost factor is very important. Then the final thing you should look at will be whether the fund's objectives or style have changed in the past 5 years. So in the first 3 years, if it has performed very well and then the fund has changed its nature, then that past track record will not be very relevant to you today. So that's the reason you have to keep track of any changes in the fund's objectives or style over this period.
Okay. So when is a good time, Aarti, to go in for these specialized funds? So mid caps and thematic funds. Do you go in the beginning, or do you wait for a certain time? You look at mutual funds and then get into it. Do you study them? How do you go about getting into these specialized funds?
As I said, these kind of funds are not for novices. Now, if I'm just entering the workforce, I've just begun to earn, I'm putting away some money as savings, I'm just starting on a mutual fund portfolio. Now, that's not a good time to go and buy an infrastructure fund or a small cap fund. I'm saying that because I explained in previous episodes about how equity funds by themselves can subject you to huge swings along with how the market performs. So last year in 2008 when the market crashed, there were theme funds which fell by 80% or so. So much more than diversified funds, these funds can take you on a very rough ride. So what I'd suggest is build your core portfolio around 3 or 4 funds which are diversified, plain vanilla schemes. Now these schemes, the fund manager will take a call on which sectors he needs to invest in, whether he needs to pick the larger stocks, the smaller ones or the mid-cap ones. Once you've exhausted that, you've built a portfolio of 3 or 4 funds that's yielding you steady returns over a period of time, then you may get the familiarity with the markets to really dabble in these other themes. Now, typically with a theme fund, for example, many of the theme funds are built around a sector or a particular idea, say an infrastructure fund or a Buy India fund, which is linked to the consumption story and so on. Now, to take a call on these theme funds, you need to know something about how infrastructure stocks are doing, how infrastructure companies may perform over the next 5 or 10 years. Now, those kind of things are not really very easy for the lay investor to do.
So, you're saying that we need to actually track one of these industries to actually know exactly what is happening. Either you belong to that industry to absolutely know, or you read all the research over it and then get into this particular fund.
You need to know when to get in and also when to get out, because themes can sometimes play out very quickly. If you see in the markets of 99-2000, when there was that massive dot-com boom, there were a huge number of funds launched around the theme of internet opportunities and new millennium and all that. You will find today none of those funds exist, or they have been restructured into more plain vanilla funds, because the stocks that participated in that theme had a huge boom period and a bust period, and they didn't recover quickly from that bust. So that is the reason why I'm telling you that investors, especially if they're lay investors, they need to start with diversified funds. Once they acquire familiarity with the market or they have a deeper understanding of a particular industry, then they can venture into theme funds or other sorts of funds.
Thank you so much, Aarti. Stay tuned to Businessline for more.